What we've witnessed in the second quarter has what we could call a melt up in the global equity market, specifically here in the U.S. The AI or artificial intelligence-driven frenzy around technology, combined with the fact that investors think the Federal Reserve is going to be able to come in and cut interest rates in the near term, has fueled money back into those expensive PE multiple sectors like technology and growth. We are very cautious about chasing this momentum in this rally, and that's because of several things. First of all, it hasn't been a broad-based rally. It's been concentrated in technology in a select few names. If you go off of the bottom, the bear market bottom in October of 2022, there's been the top 10 companies, the top 10 market cap companies in the S&P 500 have made up more than 40% of this return. This is not sustainable in an environment where we think that economic growth will be challenged. And when you look at this chart, it shows you that if you look at leading indicators, so this is really the best summary that we can see of the broad economy. These are deeply negative on a year-over-year basis. And historically, it coincides with weakness in the equity market. But what we're seeing now is that the equity market's rising significantly on a year-over-year basis, and yet at the same time, leading indicators are declining. So we don't think from a fundamental basis that this rally is justified. Also, when you look at from a valuation basis, what you see is that valuations are really pricing in perfection. They're pricing in the hope that the Fed is done raising interest rates, the economy is going to have a soft landing. All of these things, there's just way too many risks out there that we think are still outlying that investors should be chasing this rally. Instead, what we're doing with our global equity exposure is get yourself to neutral the benchmark. Don't be completely out of the market. Just get closer to neutral with the benchmark. Hold cash on the sidelines. We know that it's difficult when the market's rallying, 20, 30% in some sectors year to date, but it's prudent in this environment to be very careful of what's going on from an economic standpoint and a central bank standpoint. Have dry powder to put to work. We're going to look at opportunities in the equity market that'll benefit when we come out of a recession. Think of small and mid-cap stocks. We'll continue to look at international stocks that right now are still relatively cheap compared to the U.S. But at this point, we're not chasing this rally. We're being defensive, we're staying neutral, and we're having dry powder to put to work.